Kyle McCarthy from PIMCO. Welcome to the Alternatives Symposium.
Thank you so much. Pleasure to be here.
Could you expand on the universe of investments for the private credit strategy?
Yeah, sure. So the way that we define private credit PIMCO is actually across 4 different verticals. So think of it as a multi-sector approach. One being corporate credit or corporate direct lending. Commercial real estate debt would be number 2. Residential mortgages would be number 3. And specialty finance being the last category. And that's more or less a miscellaneous, if you will, that's anything non-corporate, non-real estate oriented. It includes things like consumer lending, so student loans, auto, credit card receivables, aircraft leasing, and even more esoteric things like music royalties or other forms of royalty streams, reinsurance, litigation finance. It's a very, very broad category. So it's a key point that we've actually been educating clients on for quite some time is think broader about private credit. I know oftentimes it's defined very narrowly as just one of those verticals, right, as a single sector strategy, but a multi-sector approach actually gives you much more flexibility. You can pivot depending on the type of economic environment you're in or where risk return makes the most sense, right? So it very much is a relative value assessment.
And is that an underappreciated source of diversification?
I think so, yeah, because as you think about the underlying risk factors in each of those categories that I mentioned, clearly corporate is driven by corporate cash flows, very much tied to the corporate credit business cycle. Commercial real estate and residential mortgages on a completely different cycle that actually tends to lag the corporate one. And the fundamentals that we're seeing today across, just comparing those two as a starting point are quite different. So we actually do expect credit fundamentals to deteriorate a bit on the corporate side. The real estate markets look a bit healthier, at least from a lending perspective. And then specialty finance, I mentioned music royalties, litigation finance, reinsurance, consumer loans, each of those have their own underlying risk factors as well. So it really is quite diversifying. And I think benefits, an investor's portfolio from a portfolio construction perspective to get access to each of those areas.
And what's the most compelling attribute of private credit today?
It's a great question. So, I normally frame it to investors as the 3 Ds, right? So it's, investing in private debt or private credit is about high distributions, number 1, diversification, number 2, and downside protection, number 3, right? The 3 Ds. I think as I look across each of those 3 categories today, the distribution side or the yield potential today is actually the highest we've ever seen since the market was really born in 2010. So from a purely valuations perspective, it's quite attractive. We basically have gone from, call it 6 to 7% yields in US dollar terms to close to 11, 12% all-in yields today. So purely from a yield generation, stable income, cash flow perspective, it's quite attractive. I would say that's probably the one I would highlight the most. However, I think that you still want to take a more balanced approach because in some cases we do expect fundamentals to decline, right? And so you want to still be selective. And that's where the downside protection or the defensiveness comes in as well. And given kind of the shift in pricing that we've seen in the markets over the past year, we've definitely come from a world of where it was very borrower-friendly terms to now much more lender-friendly terms. So the downside protection has actually been enhanced as well. So you're seeing better risk-adjusted returns right now if you're being selective, which I think is one of the key shifts that we've observed over the past 12, 18 months.
And how important is PIMCO's broader depth and research capabilities when operating in private markets?
Yeah, it's incredibly important to have large scale, to have constant presence across each of these areas. And again, it's a relative value framework, right? And so you want to be thinking where is the most compelling risk-adjusted returns across each of these 4 areas and be allocating in a dynamic, active way. The broader platform being so integrated and being, very open architecture, if you will, means that the teams are constantly cross-collaborating with one another. And so if we're doing a corporate deal where, because these are typically senior secured loans, secured by what? Sometimes it's inventory, sometimes it's real estate, right? Or the building itself that company owns, that team can partner with our commercial real estate team to come up with an updated value for what we think that collateral is worth. So we don't have to just rely upon third-party views, third-party appraisals. We can do our own underwriting work, make sure that the assumptions are really conservative. I think that cross-collaboration is quite unique with our platform. Oftentimes you see very siloed platforms where the corporate team will never speak to the real estate team and have no idea what the left hand is doing on the right hand side. So it's important that those teams are actually, that connective tissue is there.
And what are some of the big benefits of global credit versus domestic or Australian credit?
Yeah, so I travel a lot around the globe speaking about credit, both public and private. And what I've noticed is the definition of private credit varies widely depending on where I am. In Australia, domestic, it's mostly about real estate, right? And part of that is because the real estate market has been in such a boom for many decades here that's where you've seen most of the growth and most of the releveraging and increase in the debt stock. As I look outside of Australia, if I were to go to the US or to Europe, when you say the term private credit, what most folks will jump to immediately is, you mean middle market direct lending, so corporate lending. So it's interesting to see that dichotomy in that, here it means real estate, elsewhere it means corporate. And again, I think what we encourage investors to do is actually think even broader than that, right? Combine the two, but also include whole loan mortgage pools, right? Include that whole world of specialty finance as well. And what it does is it opens up the full universe, right? The markets are largest and deepest in the US. And so by not looking offshore from an Australian investor's perspective, you're missing out on the largest component of private credit markets. The other is Europe. It's probably about a quarter to a third the size of that of the US, but it's still quite sizable, right? Multiple $100 billion worth of opportunity. And so by ignoring those, you are missing out on potential diversification benefits and access to pretty unique asset types that, again, you're not going to have elsewhere within your portfolio. The US and Europe are really the largest rivers out there in terms of private credit opportunity.
And how important is risk management in what's generally an asymmetric return asset class?
Very, very important. I mentioned the 3 Ds, right? Distribution, defensiveness, and diversification. I mean, that defensiveness point is absolutely paramount as we look to debt deals, right? Debt is different than equity in that it's all about the downside, right? In the best case scenario, we get paid income yield throughout the life of the loan, and then hope to get paid back at the end, right? Return of capital as well as return on capital. So the downside focus is a key focus of ours as we think about underwriting. And in every deal that we're doing, it's important to think about it from a scenario analysis, right? So we always start with the base case, right? Here are our conservative assumptions. If things go to according to plan as we would expect, but then also have a downside scenario and an upside scenario. And so you're looking at the full spectrum of potential returns, right? It's not just a single point estimate. And that is required for every single deal that we are underwriting as part of the analysis. To take it to the investment committee, it has to have that kind of scenario analysis, stress testing included within it. So absolutely important, and especially important today, given we do think growth is slowing, and with fundamentals declining in certain sectors, heightened focus on downside protection will be key.
Kyle McCarthy, thank you.
Thank you so much.